Hi, this is Dora DeLellis with ThoughtsOnTheMoney.com. Welcome back to my vlog where I discuss money issues and offer practical money management tips. Today's topics are being the CEO of your life and envisioning your future financial self. But before I get to that, I would like to flash back to 2008. Last week, I discussed the events that unfolded at Bear Stearns, which led to the acquisition by JP Morgan. People mistakenly believe that the Great Recession started with the bankruptcy of Lehman Brothers, but that's not actually when the beginning started. The beginning happened from the bankruptcy of the two Bear Stearns hedge funds that was in July 2007. The bankruptcy of Lehman Brothers was announced September 15th of 2008, and I saved a Business Week issue just to see what the before and after looked like at the time, what was being reported, and if there were any indications in that August issue that indicated that a bomb was about to explode. So I flipped through to see what was being reported at the time, and if there was any pending news of the mortgage crisis that was building. I didn't find anything that forewarned of a catastrophic financial event. But I did find one article that I thought was interesting, and it reported on 48 lenders that had created a new online payment alternative for people to make their mortgage payments. And they start by indicating that consumers wanted to take advantage of reward points and cashback arrangements, and they wanted to be able to have an alternative to charge mortgage payments so they could take advantage of those programs. But really, reading between the lines to me, I think it was indicative of the predatory lending that was going on at the time. And what happened with the subprime mortgage market was this reckless borrowing and reckless lending. The lenders had created such sophisticated mortgage products that the borrowers really didn't understand them. And the lenders had also reduced their verification procedures to the extent that they had a term for it called NINJA. No income, no job, no assets. And these were the types of people that they were getting into home buying with mortgages, large mortgages. That's a very predatory lending aspect, especially when they throw in teaser rates, negative amortization, and balloon payments. I don't think these people understood the reality of the shift in the adjustable rate mortgages. And very shortly after, well, maybe not that quickly, maybe it took a few years, but once that interest rate reset, that was when they were not able to make those payments because they just didn't have the income or the collateral or the assets to be able to support a loan of that size. So by reading this article, I believe that the lenders created this alternative because they started to notice that people were falling behind in their mortgage payments, and they were giving them an avenue of relief, of what seemed to be relief. So when people took advantage of this, what they really were doing was robbing Peter to pay Paul and taking on that debt at a much higher interest rate. The mortgage interest rates at the time were only between 5 and 6%. But the interest rates on credit cards were somewhere around 13, 15% or possibly higher. That means that they were probably going to stay in debt for a much longer time and continue accruing interest payments and have a much longer time span of paying down that debt. So I feel that this is very indicative of what was happening at the time. So I'll be continuing with the timeline of the events that happened 10 years ago, but I'd like to continue with today's topic. Today's first topic is being the CEO of your life. A business runs under the following formula: revenue less expenses equals profits. A good CEO works with each component to generate profits for the business. I would like for you to focus on this formula as we work through the components so that you can shift your attitude from the typical employee rationale of earning and spending. People earn income and immediately spend the whole amount. As they earn more, they will also spend more. So let's look at the first component, revenue. This is the income of the business. It involves monitoring revenue streams and projecting income growth. You should be doing the same because without income, there would be no formula. Project out your earnings, decide how to utilize your current earnings in a more effective manner, or determine how to increase your current income. The next component is expenses. This is critical because CEOs watch expenses very carefully, and when income sources are limited, sometimes the only alternative is to reduce expenses. On a personal level, this translates to being very careful about spending and determining your needs versus your wants. Then you want to plan spending so that you're spending money at the same rate that you're earning it. This avoids taking on huge amounts of debt, which will follow you as you continue on and may have other necessary spending needs while you're trying to pay off that debt. Profits is the amount left over after expenses have been paid. A good CEO manages the profits by investing in short-term instruments and will plan the use of that money for large capital purchases that will enhance the revenue of the business. So the bottom line is working each of those components so that there's an amount left over in a personal situation at the end of each month. And that amount is used to generate future income. And here's a great example of how this formula is used. I read about this a couple of months ago, and I thought it really demonstrates how this formula is effective and can be applied to anyone's personal situation. The article talked about, and this is extreme, earning a minimum wage and still being able to accumulate wealth. And they used the city of Buffalo as an example because it has a low cost of living. So if someone was earning a minimum wage and living in Buffalo, they would be able to pay a low enough rent and have low enough living expenses to generate profits for themselves at the end of the month. And they would use that money to invest in assets that would either give them passive income or generate growth. And by them doing that over their lifetime or over a period of years, they would accumulate wealth so that they would have a comfortable retirement or possibly retire early. But the bottom line is it all comes down to your living expenses and necessary expenses. So if you're living in an area where your living expenses are very high, you need to figure out how to change your personal circumstances to make this formula work for you. So your profits are going to be what's left over at the end of the month to be put to work for you. And by keeping this formula in mind as the CEO of your life, you can have a sharper focus of how you're generating those personal profits. There's another concept in accounting that applies to business called going concern. Going concern implies that a business has no end date and continues in perpetuity. And I want to bridge that to today's next topic. Today's second topic is envisioning your future financial goals. There's been research conducted that can predict a person's success in attaining retirement assets and saving towards future goals that are dependent upon several behavioral factors. The first factor is called similarity to future self. The second factor is called positivity of future self. And the third factor is vividness of future self. The first factor, similarity to future self, determines the ability of a person to relate to the person that they will be in the future. And the stronger that they feel that their future person is closer to who they are today, actually enhances their successful rate of saving towards the goal that for their future financial status. The second factor is positivity of future self. And this involves the level that of positivity that a person feels towards their future life. And unfortunately, some people feel very negatively of their future self if they're currently experiencing an illness or if there are genetic illnesses in the family that have led to early deaths. So you can see how how extreme it could be. If the stronger that a person feels positive about their future self, the better success they have of reaching future financial goals and saving towards their retirement. The third element is the vividness of future financial self. And this is the key factor in predicting not only savings rates, but the ability to delay gratification. So the vividness of a person's ability to envision their future financial self is really a muscle that should be developed and kept as strong as possible. If you're someone who's looking to reach financial goals, try to work on the vividness of envisioning your future financial self. So the questions I leave you with today are, as financial CEO of your life, what's one thing you would do to change your financial position today? And number two, how does your financial future look? So join me next time when we get into investments and I start discussing cryptocurrencies. Please leave questions and feedback on thoughtsonthemoney.com. Thanks, and I'll see you soon.